Managers often use two terms synonymously with incentive plans. All incentive plans are pay for performance plans. They all tie employees' pay to employee performance. On the flip side, some limit the term variable pay to group or team incentive plans. Incentive pay, tying worker pay to performance, is a popular mechanism. The problem is that doing so is easier said than done. Research on incentive plans is sketchy, but one older study found that just 28% of 2,600 US workers said their company's incentive plans motivated them. One expert found that employees don't see a strong connection between pay and performance, and their performance is not particularly influenced by the company's incentive plan. One problem is that many incentive plans incentivize the wrong behavior. Incentives that may motivate some people don't motivate others. Several motivation theories have particular relevance for designing incentive plans. Frederick Herzberg said the best way to motivate someone is to organize the job so that doing it provides the challenge and recognition we all need to help satisfy higher level needs for things like accomplishment and recognition. These needs are relatively unstable, so challenging work provides sort of a built-in motivation generator. Doing things to satisfy lower level needs, like better pay, just keeps the person from becoming dissatisfied. In organizational psychology, intrinsic motivation is motivation that derives from the pleasure someone gets from doing the job or task. It comes from within the person rather than from externally, such as a form of financial incentives plans. Intrinsic motivation means that just doing the task provides the motivation. Instead of relying exclusively on financial incentives, the employer should also provide the recognition and challenging work that most people crave. Psychologist Edward Deci found that extrinsic rewards could at times actually detract from the person's intrinsic motivation. Meaning, incentive pay for highly motivated employees may inadvertently demean and detract from the desire they have to do the job out of a sense of responsibility. In general, people won't pursue rewards they find unattractive or where the odds of success are relatively low. Psychologist Victor Vroom's expectancy motivation theory echoes these common sense observations. He says that a person's motivation to exert some level of effort depends on their expectancy, instrumentality, and valence. Vroom's theory has three implications for how managers design incentive plans. First, if employees don't expect that effort will produce performance, no motivation will occur. Second, Vroom's theory suggests that employees must see the instrumentality of their efforts. They must believe that successful performance will in fact lead to getting the reward. Third, the reward itself must be of value to the employee. If any of these are zero, motivation simply will not exist. Piecework is the oldest incentive plan and still the most commonly used. Earnings are tied directly to what the worker produces. The person is paid a piece rate for each unit they produce. Developing a workable piece rate plan requires job evaluation and ideally industrial engineering. Job evaluation enables you to assign an hourly wage rate for the job in question. But the crucial issue is the production standard, and this is often developed by industrial engineers. The engineers state production standards in terms of a standard number of minutes per unit or standard number of units per hour. Piecework generally implies straight piecework, a strict proportionality between results and rewards regardless of level of output. The standard hour plan is like a piecework plan with one difference. Instead of giving a rate per piece, the worker gets a pay premium equal to the percent by which his or her performance exceeds the standard. Piecework incentive plans have several advantages. They're simple to calculate and easily understood by employees. Their incentive value can be powerful since they tie pay directly to performance. Piecework also has disadvantages. One is an unsavory reputation based on the employer's habit of arbitrarily raising production standards whenever workers earned excessive wages. A more subtle drawback is that because piece rates are quoted on a per piece basis, in workers' minds, the production standard in pieces per hour becomes tied inseparably to what they earn. Piecework plans can thus endanger rigidity. When the employer tries to raise production standards, resistance ensues. Employees may similarly focus on less quality and may resist switching jobs, since doing so would reduce productivity. Even equipment maintenance may suffer as employees push it to hit quotas. Merit pay or a merit raise is a salary increase that an organization awards based on individual performance. It's different from a bonus in that it usually becomes part of the employee's base salary, whereas bonuses are generally one-time payments. Merit pay has pros and cons. Advocates say granting pay raises across the board without regard to merit reduces performance by rewarding employees regardless of how they perform. Detractors argue most notably that since most appraisals are unfair, so too are merit decisions based on them. A recent survey found that only 20% of employers in North America said merit pay drives higher levels of performance. This survey also concluded that awarding raises for demonstrating job critical knowledge and skills was the better option. If merit pay plans aren't working, one sensible reaction would be to improve it. This starts with establishing effective appraisal procedures to ensure that managers actually do tie merit awards to performance. Two merit pay adaptations are popular. One awards merit raises in a lump sum once a year. Traditional merit increases become part of the employee's salary, but these lump sum merit raises do not. This can be beneficial because the merit raise is not backed into the employee's salary, so you need not pay it year after year. Another adaptation ties merit to both individual and organizational performance. Professional work involves applying knowledge to solve employers' problems. Making incentive pay decisions for professional employees is challenging. For one thing, firms usually pay professionals well anyway. For another, they're already driven by the desire to produce high caliber work. However, it's unrealistic to assume that people like Google engineers work only for professional gratification. Few firms, therefore, work harder than Google to maintain competitive incentives for their professionals. Dual career ladders is another way to manage professional pay. At many employers, higher pay requires rerouting from, say, engineering into management. However, not all professionals want to be managers, and that's where dual career paths pay off. Employers often supplement financial incentives with various non-financial and recognition-based awards. Recognition programs usually refer to formal programs such as Employee of the Month. Social recognition generally refers to informational manager-employee exchanges such as praise, approval, or expressions of appreciation for a job well done. Performance feedback means providing quantitative or qualitative information on task performance so as to change or maintain performance. Showing workers a graph of how their performance is trending is an example. There are simply too many opportunities to motivate employees every day to let those opportunities pass. The best option for motivating an employee is also the simplest. Make sure the employee has a doable goal that they agree with. Second, recognizing an employee's contribution is a powerful motivational tool. Studies show that recognition has a positive impact on performance, either alone or combined with financial awards. Third, use social recognition apps for positive reinforcement. Although not usually considered an incentive, job design can affect employee motivation. A study by Harvard Business School researchers concluded that job design is a primary driver of employee engagement. Another study conducted that challenging work ranked as the seventh most important driver for attracting employees. Job design can thus be a useful part of a total rewards program. Sales compensation plans focus on salary, commissions, or some combination of the two. Some firms pay salespeople fixed salaries, perhaps with occasional incentives such as bonuses, sales contest prizes, and the like. Straight salary makes sense when the main aim is prospecting, finding new clients, or account servicing. Recruiting is another reason. Faced with difficulty attracting good salespeople, a car dealership in Lincolnton, North Carolina, offers a straight salary as an option to salespeople who sell an average of at least 8 vehicles a month. Straight salary also makes it easier to switch a salesperson's territory. The main disadvantage is that straight salary lacks commissions motivation and the potential to increase sales. Straight commission pays salespeople only for results. Commission plans tend to attract high-performing salespeople because they see that effort produces reward. Sales costs are proportionate to sales rather than fixed, and the company's fixed sales costs are thus lower. Such plans are easy to understand and to compute. Commission plan alternatives include straight commissions, quota bonuses, management by objective programs, and ranking programs which reward high achievers but pay little to no bonuses to the lowest performing salespeople. About half of companies surveyed use top-line measures like revenue, while others use bottom-line criteria like profits. Some also use non-sales measures. However, in more poorly designed plans, salespeople may focus on making the sale and neglect non-selling duties such as servicing small accounts and pushing hard-to-sell items. If the persons can't sell, commissions won't help. Most companies pay salespeople a combination of salary and commission. This combination varies by industry and by what the company hopes to achieve, but a split of about 60 to 70% base salary and 40 to 30% incentives seems typical. Combination plans have pros and cons. They give salespeople a floor to their earnings, let the company specify what services the salary component is for, and still provide a performance incentive. But the salary isn't tied to performance, so the employer trades away some incentive value. Combination plans also tend to be complicated, so misunderstandings can ensue. That isn't a problem with a simpler salary plus commission plan, but most plans aren't that simple. For example, in a commission plus drawing account plan, the salesperson is paid based on commissions, but can draw on future earnings during low sales periods. In the commission plus bonus plan, the firm pays its salespeople mostly based on commissions. They also get a small bonus for directed activities like selling slow-moving items. In setting sales quotas, one wants to motivate sales activity but avoid excessive commissions. Unfortunately, the tendency to set commission rates informally often reduces such plans' effectiveness. Setting effective quotas is an art. Here are some thoughts. 75% or more of the sales force achieving quotas or better. 10% of the sales force is achieving higher performance levels, and 5 to 10% of the sales force falls below the quota. Firms must consider the effect of sales carryover. In most firms, a significant portion of sales in one year reflects a carryover of sales from the prior year. These are sales that would repeat even without any effects by the sales force. Paying a sales force a commission on all the current year's sales means the employer pays a commission on last year's carryover sales, which the salesperson had little or no role of bringing in this year. A survey of sales effectiveness reveals that salespeople at high-performing companies receive 38% of their total cash compensation in the form of a sales incentive pay, compared with 27% for salespeople at low-performing organizations. Distinguishing among performers is also important. For example, some companies distinguish among stars, laggards, and core sales performers. Companies that limit commission earnings may actually encourage stars to stop selling when they reach their quotas. Laggards do better with more frequent quarterly bonuses and social pressure to improve. One expert advocates acceleration, where the commission rate rises for those who meet their sales target. Finally, track costs of sales. For instance, a salesperson's salary plus commissions plus bonus opportunities divided by that person's sales revenue. Many employers use Enterprise Incentive Management or EIM to track these sales commissions. Sales incentives are rewards offered for exceeding a predetermined sales goal. Traditionally, a car salesperson's commission is based on a percentage of the difference between the dealer's invoice cost and the amount the car is sold for, minus an amount to cover the dealer overhead. This approach encourages the salesperson to hold firm on the retail price and to push after sale products like floor mats and side moldings. There may also be extra incentives to sell packages such as rust proofing. For selling slow moving vehicles, the salesperson may get an extra incentive bonus. The executive's reward components must align with each other and the company's strategic aims. Compensation experts suggest first specifying the strategic aims, then deciding what long-term behaviors are important for achieving these strategic aims. Next, shape each component of the executive total compensation package to encourage these required behaviors, then combine the components into a plan. Using multiple strategy-based performance criteria for incentivizing executives is best, including financial performance, number of strategic goals met, employee productivity measures, and employee surveys. One expert estimates that typical CEO salary accounts for about 1/5 of their pay, a bonus based on explicit short-term performance for another fifth, and long-term incentive rewards, such as stock options, for the remaining 3/5. Ideally, the performance standards should include a combination of market benchmarks, such as performance against competitors, as well as business performance standards, such as earnings per share growth. The Sarbanes-Oxley Act of 2002 affects how employers formulate their executive incentive programs. Congress passed Sarbanes-Oxley to inject a higher level of responsibility into executive and board member decisions. It makes them personally liable for violating their fiduciary responsibilities to their shareholders. For better or for worse, employers are shifting away from long-term incentives to put more emphasis on short-term performance and incentives. Most firms have annual bonus plans for motivating managers' short-term performance. Traditionally, most employers based annual bonus eligibility on job level, base salary, or other status. Recently, more employers were offering a broader range of employee annual incentive plans. A percentage size of any bonus is typically greater for top executives. An executive earning $250,000 in salary may be able to earn another 80% as a bonus, while a manager earning $100,000 may earn only another 30%. Second, one must determine how big the annual bonus fund should be. Most employers estimate the likely bonus for each eligible employee and total those to arrive at the bonus pool size. Finally, one must decide the actual individual awards. Typically, the employer sets a target bonus for each eligible position. The actual bonus then reflects the manager's performance. One question is whether to give managers bonuses based on individual performance, corporate performance, or both. Firms usually tie top-level executive bonuses mostly to overall corporate results. Many firms end up tying short-term bonuses to both organizational and individual performance. Employers use long-term incentives to inject a long-term perspective into their executives' decisions. Popular long-term incentives include cash, stock options, stock appreciation rights, and phantom stock. Long-term incentives, such as stock options, if well designed, should only pay off if the firm achieves its strategic goals, because the owners and investors should also benefit from the executive's effort. Long-term incentives must also be golden handcuffs, motivating executives to stay by letting them accumulate capital that they can cash in only after a certain period. People put their efforts where they know they'll be rewarded. Organizations offer other executive incentives to their CEOs and top-level executives. Some incentivize executives to stay with the firm. This is especially important when executives might flee because another company is stalking the firm with incentives to buy it. Golden parachutes are extraordinary payments made to executives in connection with a change in company ownership or control. They usually include a combination of severance pay, accelerated vesting, and other benefits. Firms increasingly rely on teams to manage their work. They therefore need incentive plans that focus teams on performance and encourage teamwork. Team or group incentive plans pay incentives to the team based on team performance. Companies usually incentivize teams in one of three ways: pay the same incentives to each team member, pay different rates to each member based on performance, and paying different rates to each group in some proportion to base pay. The usual approach is probably still to tie rewards to some overall standard of group performance, such as 10 labor hours per car. One company established such an overall standards for work teams. If the firm reached 100% of this goal, the employees would share in about 5% of the labor costs saved. If the firm achieved less than 100% of its goal, the bonus pool was less. Well, most employers just use their experience to estimate what the team goal or standard should be. Others carefully engineer their production standards, often basing the team incentive on either a piece rate or a standard hour plan. All team members then typically receive the same share of the team's incentive pay. Thus, the team might receive, say, $5 for each wheel installed above the industrially engineered standard of 10 wheels per hour. Team incentives often reinforce team problem solving and can help ensure cooperation. Team incentives also facilitate training, since each member has an interest in getting new members up to speed fast. The main disadvantage is the demotivating effects of free rider workers. Studies suggest that team incentives are often counterproductive. A researcher studied business students enrolled in a graduate online MBA program. She devised a method for categorizing how they said they reacted to the team incentives they'd experienced in the past. Inequity was the big problem. Sometimes all team members' financial compensation was the same, although one or two people did the majority of the work. In other cases, the employer chose one or two team members for promotion, leaving others to feel they'd worked hard to support someone else's career. The bottom line is that unless you take steps to minimize interpersonal inequities, it may be best to pay employees based on their individual contributions rather than on collective team performance. Organization-wide incentive plans are plans in which all or most employees can participate, and which generally tie the reward to some measure of company-wide performance. Also called variable pay, we'll look at most of this in upcoming courses. With profit-sharing plans, employees receive a share of the firm's annual profit. Well, that sounds good in theory. Free riders may again be a problem. Some may ask, if everyone gets paid at the same, whether or not they work hard, why bother? Other studies found that profit-sharing plans boost productivity and morale, but that their effect on profits is insignificant once you factor in the costs of payouts. A more recent study found that employee earnings rose faster in firms with profit-sharing plans. There are several profit-sharing plans. With current profit-sharing or cash plans, employees share a portion of the employer's profits quarterly or annually. Here, the firm simply distributes a percentage of profits, usually 15 to 20%, as profit shares to employees at regular intervals. With deferred profit-sharing plans, the employer puts cash awards into trust accounts for the employee's retirement. Employees' income taxes on the distributions are deferred until the employee retires or withdraws funds from the plan. These are essentially pension plans that let the employer decide how much to contribute. Few would argue with the idea that one of the best ways of ensuring that employees are engaged and motivated is to ensure that by pursuing their goals, the worker pursues the employer goals as well. The Scallion Plan, developed in 1937 by Joseph Scallion, is still popular today. The remarkably progressive plan has 5 basic features. The first is that Scallion's philosophy of cooperation is critical. This philosophy assumes that managers and workers must rid themselves of the us and them attitude. A second feature is what practitioners call identity. This means that in order to focus on employee involvement, the company must articulate its mission or purpose, and employees must understand how the business operates. Competence is a third basic feature. Three experts say the program explicitly recognizes that a scallion plan demands a high level of competence from employees at all levels. This suggests careful selection and training. The fourth feature of the plan is the involvement system. Employees present improvement suggestions to the appropriate department level committees, which transmit the valuable ones to the executive level. If a suggestion is implemented, all employees usually share in 75% of the savings. Gain sharing engages employees in a common effort to achieve productivity objectives. In addition to the Scallion plan, other popular gain sharing plans include the Lincoln, Rucker, and InfoShare plans. The basic difference among these plans is how employees determine employee bonuses. The Scallion formula divides payroll expenses by total sales, or sometimes by sales plus increases in inventory. In one version of the Lincoln incentive system, first instituted at the Lincoln Electric Company of Ohio, employees work on a guaranteed piecework basis. The company then distributes total annual profits less taxes, 6% dividends to stockholders, and a reserve each year among employees based on their merit rating. Most firms customize their gain sharing plans. Results support gain sharing's effectiveness in setting ranging from automotive parts manufacturers to hospitals. For example, in one study, cost savings achieved by hospital physicians translated into cash payments to the physicians. The U.S. Department of Health and Human Services approved this hospital type of gain sharing. Pay-for-performance plans can support an employer's cost control effort. Base pay and benefits represent the majority of labor costs, and normally neither varies much even when sales plummet. Pay cuts adversely affect morale, and if sales fall in one year, it's generally hard to cut labor costs without downsizing. Employees agree to put some portion of their normal pay at risk if they don't meet their goals. Employee stock ownership plans, or ESOPs, are retirement incentive plans. The organization generally makes these contributions to the trust annually in proportion to total employee compensation up to a limit of 15% of compensation. It then distributes the stock to vested employees upon retirement. ESOPs are popular because the company receives a tax deduction equal to the fair market value of the shares it transfers into the trustee. Employees aren't taxed until they receive a distribution from the trust. A survey provides some insights into the role of incentive pay in forecasting employee engagement. Of approximately 6,300 compensation professionals some researchers studied, 736 responded to a survey. Here's what they found. Although the compensation professionals believe that total reward programs can influence employee engagement, many of them did not specifically include engagement as one of the goals of their compensation plan. About 60% agreed or strongly agreed that employee engagement and performance metrics are incorporated into variable pay programs in their organization. But only 37% agreed or strongly agreed that the organization engagement levels fostered by line managers were an important factor in evaluating performance. They concluded that to encourage employee engagement with incentives, firms should measure the extent to which supervisors are encouraging engagement and then use incentives to reward supervisors for improvement. Getting employees involved in developing the reward program was the gold standard.